I'm joined now by Hewin. She's senior economist at StanChart's. Thanks so much for joining us. So a lot of headlines there from Moody's. Which country should we be the most worried about?
Well, obviously, Greece stands out as the country which is going through problems at the moment. It's the country which potentially is still most at risk, I think, from another ratings downgrade. Having said that, I think that the ratings agencies are holding fire for now. Greece has made substantial cuts to its deficit, and it looks likely that they'll be able to get through the next few months, hopefully without too many difficulties.
The next few months, that is. But EU leaders, how do you think they're handling this situation? Do you get the sense that they're just kind of crossing their fingers, closing their eyes, and hoping that this problem doesn't spread?
Well, they're certainly hoping that the problem doesn't spread, and contagion to other high debtor countries in the euro area is a real concern of EU policymakers. But they're not really just shutting their eyes and hoping it'll go away. They're doing quite a lot behind the scenes to make sure that there's some sort of bailout package in place should Greece find that it can't raise the money that it needs from the markets.
Now, you heard Mark just talking about Martin Feldstein's comments. He was the guy, of course, that warned 2 decades ago that the euro would be an economic liability. He also said that Greece's austerity plan is going to fail. They're going to have to exit the euro. Is that still a possibility, something like that?
Well, I mean, Greece has gone a long way to cutting its deficit. They've got a plan in place for reducing the deficit over the next 3 years. The ratings agencies, the European Union, say that it looks credible. So I think that that's quite a harsh comment. As for leaving the euro, it makes no sense whatsoever for a high debtor country to leave the euro. The cost of financing its deficit would be enormous.
OK, well, let's talk about financing deficits then, because you have the UK and the US. They don't face an immediate threat of being downgraded, but Moody's was warning about them. So it's all about how their ability to finance their debt. So what does that look like?
Well, so far, so good. I mean, we're certainly here in the UK, and the Debt Management Office has not had any problems rolling over debt and raising the finance that it needs to, and that's despite the Bank of England saying that it's calling a halt to asset purchases, and that's also despite the fact that we've seen quite a sharp pickup in inflation, which you might think would make investors somewhat wary about moving into gilts. So we don't think that the UK or the US are going to face any problems with financing. It comes down to a question of what the cost is going to be. You know, will bond yields have to rise a lot further?
Now, would you say that the UK is in a worse position, say, than the US? I mean, some of the other headlines coming out from Moody's, they say UK facing one of the weakest recovery. UK debt's going to be a problem with the end of QE, for example.
Well, the UK has certainly been the laggard in terms of economic recovery when you compare it with other European countries and when you compare it with the US. But I think that the situation between the UK and the US is not so different. We're quite cautious about the outlook for the US economy, even though we've seen a strong pickup in growth in the 4th quarter of last year, likely to see quite reasonable growth in the 1st quarter of this year. Our worry is that the US will see a fading recovery as the year progresses. Right. The UK, it's a similar sort of issue, that growth is not likely to be very strong over the rest of the year.
Perhaps that's why the Fed is going to keep rates low for the foreseeable future. I mean, they've maintained their language on rates for a year now. When do you think they're going to start making that transition towards tighter monetary policy?
Well, that's quite a tough one. Our view is that the Fed won't need to raise the Fed funds rate until quite late into next year. So we're not looking for a hike in Fed funds until about the 3rd quarter of 2011. Obviously, the Fed has to prepare the markets as it gets close to that point, and it will do this by changing the language, specifically on keeping rates low for an extended period of time.
Now, we had Thomas Hoenig, one of the policymakers on the Fed's board, dissenting. He was the only one to dissent. He said he was concerned that the Fed was sowing the seeds for future economic imbalances. Is he right to be concerned about that, do you think?
Well, of course, if rates stay low for years and years, then you would expect to see imbalances reappear. But I think that for now, there's still so many uncertainties about the strength of the US economy. And this is what was made clear in the Fed's statement yesterday. They were perhaps a little bit more upbeat on the labour market, on business investment. But they warned again about the housing sector. And their language is still, I think, quite dovish. So we don't see any problems yet in terms of the Fed moving early and raising rates.
Sarah Hewin, senior economist there from StanChart's.